Okay, you want to own an oil rig, a tower of steel punching into the ground, or standing out in open water, pulling barrels of black gold out of the earth around the clock. It looks like the ultimate business. The ground is basically handing you money, one barrel at a time. Here's what nobody tells you before the first bit ever touches rock. An oil rig isn't a business built on finding oil. It's a business built on surviving the 18 months between spending tens of millions of dollars and knowing whether there's anything down there worth pumping, and everything expensive about this industry exists to manage that one brutal fact. The ground doesn't care how much you've already spent. The price of oil doesn't care what your well cost to drill. The regulator definitely doesn't care. So what actually makes an oil rig profitable? Not the gusher, not the size of the reservoir. It's the discipline to survive the gap between spending the money and knowing if it worked. Let's build the real numbers, starting before a single foot of pipe goes into the ground. Before you drill anything, you need the right to drill, and that right is separate from owning the land itself. Mineral rights can belong to a private landowner, the state, or the federal government, and you have to lease them before you're allowed to touch what's underneath. The upfront signing bonus can run anywhere from a few $100s an acre in an unproven area to tens of thousands an acre in a hot basin. On top of that, the mineral owner keeps a royalty. Typically 12 to 25% of everything the well ever produces paid off the top before you see a dollar. Offshore is a different game entirely. You're leasing blocks from the federal government at auction, and a single deepwater block can cost a few $100,000 to tens of millions of dollars before a single seismic survey is even run. And most leases expire if you don't drill within 3 to 5 years, so the clock starts ticking the moment you sign, whether or not you've actually raised the capital to drill. Before you commit tens of millions to a well, you want a better guess than a landowner's story about an old gusher 3 farms over. Seismic surveys send sound waves into the earth and map what bounces back. A modern 3D survey commonly costs $1 to $5 million, far more offshore where specialized survey ships are involved. Even after all of that, seismic doesn't tell you there's oil down there. It tells you the rock formations look like the kind that sometimes hold oil. The only way to actually know is to drill, which is exactly why so much of this business is spent trying to reduce uncertainty that can never fully be eliminated. Now, the rig itself. Almost nobody who drills wells actually owns the rig. You lease it from a drilling contractor, the same way a trucking company leases a hauling contract instead of building its own highway. An onshore land rig can cost a few million to over $20 million to build, depending on depth and automation. Offshore, the numbers change completely. A jackup rig, standing on legs planted on the seafloor in shallow water, commonly costs $150 to $250 million. A semi-submersible or drill ship, capable of drilling in water thousands of feet deep, can run $500 million to over $600 million. You don't build these specialized contractors who own entire fleets do, and you rent one. Renting isn't cheap, and it's the single biggest line item most first-time operators underestimate. Here's how you actually pay for that rig. A day rate, a flat fee the contractor charges for every single day the rig is under contract, whether it's drilling smoothly or sitting broken down waiting on a part. Onshore land rig day rates commonly run $15,000 to $30,000 a day. Offshore, a jackup runs $60,000 to $120,000 a day, and a deepwater drill ship can run $300,000 to over $600,000 a day for the rig alone, before crew, mud, and services. A deepwater well taking 45 days to drill can rack up $10 to $30 million in rig time alone, and every single day the rig sits idle. Waiting on weather or paperwork is a day you're paying that rate for nothing coming out of the ground. This is why day rates can collapse by more than half during a bust. The contractor needs the rig working somewhere, and you need certainty on cost. A rig runs on people, working in a way almost no other industry does. Most crews work a hitch schedule, 2 weeks on, 2 weeks off, living on site the entire time, because the rig genuinely never stops. Roughnecks handle the physical labor on the rig floor and typically earn $50,000 to $80,000 a year. The driller operates the actual drilling controls and earns $80,000 to $120,000. The tool pusher manages the entire crew and commonly earns well over $100,000. Offshore, add a company man, the operator's representative making real-time decisions worth millions of dollars, and a mud engineer monitoring the fluid that keeps the well from blowing out. On an offshore rig, total crew costs commonly run $50,000 to over $100,000 a day, layered directly on top of the day rate you're already paying. Here's the equipment that exists purely to prevent the worst thing that can happen in this industry. The blowout preventer, yes, a massive stack of valves sitting on top of the wellhead, is designed to seal the well instantly if underground pressure threatens to force oil, gas, or drilling fluid uncontrollably to the surface. A deepwater BOP stack alone can cost $15 to $30 million, and it's tested regularly, sometimes daily, because the one time it fails is the one time this entire industry becomes a headline. Regulators require it, insurers require it, and every operator remembers exactly what happened in the Gulf of Mexico in 2010 when one failed. A single blowout that cost tens of billions in cleanup, fines, and settlements. The BOP is expensive because the alternative is unthinkable. Add it all up, and here's what a single well actually costs before it produces a single barrel. A shallow onshore well might run $500,000 to $2 million. A horizontal shale well, with completion work included, commonly runs $6 to $10 million. A deepwater offshore well can run 50 to over 100 million for one well, and that's before you know whether it produces anything. A dry hole costs almost exactly the same to drill as a productive one. You've just paid full price for nothing. For shale wells specifically, drilling the hole is only half the cost. Hydraulic fracturing, pumping water, sand, and chemicals into the rock at extreme pressure to release trapped oil commonly costs $3 to $6 million on top of drilling. A single frac job needs millions of gallons of water and thousands of tons of sand, and one delayed truck can stall an entire crew standing by on full-day rates. This is why a shale well's total price tag can double from what drilling alone suggests. You're not paying for oil, you're paying for the chance to find it. And the price of that chance is the same whether you win or lose. Here's the risk sitting on top of every other cost on this list. You don't set the price of what you're selling. Oil trades on a global market that can swing from $30 a barrel to over $100 within months. A well that pencils out beautifully at $70 a barrel can lose money at $40. Same well, same production, completely different outcome, decided by a market you don't control. This is why serious operators hedge, locking in a future price through futures contracts before the oil even comes out of the ground, sacrificing some upside in a price spike in exchange for protection against a collapse. It's the same logic as a farmer locking in a wheat price before harvest. Operators who skip hedging aren't necessarily wrong, but they're betting a multi-million-dollar well on a market that has crashed by half more than once in a single year. Insurance on a business this dangerous runs far higher than almost anywhere else. Well control insurance, covering the catastrophic cost of a blowout, can run hundreds of thousands to millions of dollars a year in premiums alone, and after a major industry incident, those premiums climb sharply across every operator, not just the one involved. Add general liability, environmental liability, and offshore pollution coverage, and total insurance for a mid-size operator commonly runs into the millions annually, because a single uninsured disaster in this industry doesn't just bankrupt a company, it can bankrupt it several times over. On top of that sits permitting, federal, state, and often local, each with its own environmental review that has to be maintained for the entire life of the well, not just at the start. Groundwater monitoring, methane leak detection, and spill prevention plans all need ongoing documentation, and a violation can mean fines running into the millions along with a well shut in, meaning it earns zero revenue while the issue gets resolved. A mid-size operator commonly spends several $100,000 to a few $1 million a year on compliance alone, a cost that only tends to grow. Getting people, equipment, and supplies to a rig is its own enormous cost, especially offshore. Supply boats run continuously between shore and platform, and helicopters ferry crew changes because there's often no other way on or off a platform sitting 100 miles out. A single offshore supply vessel can cost $15,000 to $30,000 a day to charter, and a full helicopter crew change can run tens of thousands more per trip. Onshore, in remote shale basins, trucking water, sand, and equipment down roads never built for that traffic adds its own steady cost, and a single washed-out road during a storm can idle an entire crew at full day rates with nothing to show for it. Add it up for a mid-size onshore operator running a modest shale program. Drilling and completion across a handful of new wells a year, $15 million. Crew and labor, $4 million. Insurance, $1.5 million. Compliance, $1 million. Logistics, $2 million. Equipment maintenance and workovers, $3 million. Total operating and development costs commonly land between $25 and $27 million a year. And that assumes no dry holes, no major equipment failures, and no extended downtime waiting on rigs, trucks, or permits. We haven't even reached the piece of this business almost nobody outside the industry thinks about. What happens to production the moment a well starts flowing? Here's the part that surprises almost every first-time investor. A new well's production doesn't stay steady. A typical shale well can lose 30 to 70% of its output in the first year alone, then keep declining every year after, meaning the well that justified the entire investment is producing a fraction of its opening rate within 12 months. This is why operators have to keep drilling new wells constantly just to keep total production flat, let alone growing. The same treadmill a business faces when its best customers churn every year, except here the churn is on a schedule you can actually calculate in advance. And on top of that declining production, royalties and severance taxes come off the top of every barrel, commonly totaling 20 to 30% combined before you've covered a single operating cost. On a well producing $50 a barrel of revenue, $10 to $15 is gone before you've paid a single worker or a single dollar of insurance. Here's a competitive pressure unique to this industry. OPEC and its allied producers can adjust global output specifically to move the price you're selling at, sometimes flooding the market to push smaller, higher-cost producers out of business entirely. Shale operators compete on a cost curve that shifts constantly. A well that's profitable at a certain price becomes a liability if a coordinated supply increase pushes prices down for an extended stretch. And unlike a well in a giant conventional field, a shale well's steep decline rate means you can't just wait out a bad year sitting on reserves that hold their value. The clock on that specific well's production is already running, regardless of price. This doesn't mean independent producers can't compete. Many do by drilling the lowest cost basins and keeping debt low enough to survive a downturn. But the price you're planning around today can be deliberately moved by producers you'll never negotiate with directly. Even with a strong lease and a productive basin, margins get squeezed constantly. Rig day rates climb sharply the moment prices rise, and every operator wants a rig at once, meaning your drilling costs go up exactly when everyone else is also trying to drill. Service costs follow the same pattern, and compliance costs only tend to increase, never decrease. Decline curves don't pause for a bad commodity cycle either. The well keeps declining whether oil is at $40 or $90. This is exactly why so many independent drilling ventures don't make it past their first downturn. It's rarely a single dry hole that kills a company. It's usually too much debt taken on to fund the drilling program, layered on top of a price collapse nobody hedged against, on top of decline curves that were always going to eat into revenue no matter what oil did. The operators who survived treated that gap between spending the money and knowing if the well worked as the central risk of the business from day one, instead of assuming the good years would simply continue. So some operators take a different route, bringing in a partner through a joint venture or a farm-out instead of drilling entirely alone. The original leaseholder brings in a partner who covers some or all of the drilling cost in exchange for a working interest in the well, commonly splitting both the cost and the eventual production, sometimes 50-50, sometimes on more favorable terms for whoever's putting up the capital. In exchange, the original operator spreads the risk of a dry hole across more than one balance sheet and gains access to a partner's existing rig contracts, service relationships, and drilling expertise instead of building all of it from zero. A partner already drilling dozens of wells a year gets meaningfully better day rates and faster equipment access than an independent operator drilling one well at a time ever could. So the real decision isn't drill or don't drill. It's this: operate entirely alone and keep every barrel of production and every decision on the rig, accepting the real risk of a dry hole or a price collapse landing entirely on your own balance sheet. Or bring in a partner, give up a real share of production permanently, and gain the hedged pricing, service relationships, and shared risk that would otherwise take years and significant capital to build alone. Neither path removes the risk. One trades, can I survive a dry hole and a bad price cycle on my own reserves? For can I accept a smaller share while a partner's scale absorbs half of both of those problems? The dream was never really the gusher or the tower of steel. The real product in this industry is the discipline to survive the gap between spending the money and finding out if it worked, protected by hedging, by insurance, and by partners who've already absorbed someone else's bad year. Whether you carry that risk entirely yourself or share it with a partner who's already built the system to survive it, the drilling was always the easy part. The risk management was the real business. So why does anyone still pursue this, knowing everything you just heard? Because for the operators who treat this like the capital-intensive, deeply cyclical business it actually is, not a lottery ticket dressed up as an investment, the returns on a genuinely productive well can be extraordinary, and the geology underneath the risk management is one some operators are genuinely drawn to. They hedge their price before the well is even finished. They capitalize for the dry hole, not just the gusher. And they treat every service contract and every rig day rate as a number worth negotiating hard, not accepting on faith. The operators who last know one number cold, their break-even price per barrel, the exact figure below which a well stops making sense, calculated well before the drill bit ever touches rock. They're not hoping the price stays high. They already ran the math on what happens if it doesn't, and made sure they could survive it before they ever spudded the well.